Hello everybody, welcome to another video with your man, Sifu Steve, in TradingLive. So today, the video will be about the application of FVG, Fair Value Gap. In the previous slide or previous video, I talked about FVG as well, but it was about its definition. What is it all about? Very simple stuff. Today we just go a little bit deeper on its application. And without further ado, let's move to the first slide. Let's go. And the application, when we talk about applying something, a concept, an idea, we are determining how do we use it. So FVG, from my honest opinion, there's three main ways to use fair value gap. Number one, for trade entry purposes. Number two, to determine bias. And number three, as invalidation in your trades. So what does all this mean? Sounds very simple. In fact, it's actually simple. However, everything requires practice if you want to be good. So let's move to the first example. I'm going to explain the entry part. Fair value gap is infamous for traders in SMC as an entry technique, entry tool to execute buy or sell. So here we can see that price rally, it forms the fair value gap, so-called, in a 15-minute chart, right? Lower time frame. I assume that we all execute in the lower time frame time horizons. I'm talking in the sense of a scalper or intraday trader. If you're a swing or position trader, you may use 1 hour or H4, which is fine. Price is fractal, it is all the same. But this is in regards to a intraday scalper, session trader, or a scalper. That is why 15 minutes execution time frame. We can see here that price got respected once. Rally. Over here, you can enter, no problem at all. It returned for the second time, it swept the low and body candle close above. Now, the wicks does the damage, but the body tells the story. This, in fact, you can go in again, and we know that this fair value gap is a very prominent price level that could hold price to the upside. Simply enter here and you can put a stop loss below the key swing low, which unlikely will be broken because we have a fair value gap here to act as support and price continue to deliver to the upside. So this is a very simple application of fair value gap as an entry. You can utilize this in your trading strategy or plan as an execution indicator or signal. When you see such a pattern over here, this 3 candle so-called pattern, and there's a little gap over here, there's only one price running through it, any return, if your higher time frame narrative and bias, higher time frame market structure is correct, is in line with bullishness, in this case this chart, this entry indicates bullishness, this fair value gap indicates bullishness, then you are all in line to take the trade based on this fair value gap. Now the next one is to determine bias, or I would say a bias supporting tool. If we look at a daily or weekly, it shows bullish. Okay, cool. Right? Or monthly, it shows bullish market structure, making highs and lows, higher highs and higher lows. Fantastic. How do we give ourselves further confirmation on whether price would wants to deliver higher and a certain specific higher low will be formed and hold, never be broken, because price wants to deliver higher or to reprice higher. So we can use fair value gap in this case, H4, daily, H1, up to you. You choose your time frame. Price is fractal. Over here, I use the daily on the S&P 500 chart, the CFD chart. So this daily fair value gap, it swept the low over here, number one, rally, displacement, indicating smart money or institutional involvement or the order flow is potentially bullish. Okay, Now, after it pushes up so aggressively, how do we confirm that it could potentially push higher and continue on this direction? Number one, fair value gap over here, form after this candle close. The next day, poke, 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 poke. If you're not very sure with this small consolidation, you may take a small loss over there. Yeah, you may take a small loss over here. But as you see, candle 1 defended on the daily fair value gap. Candle 2 almost down, close above. Candle number 3, candle number 4, candle number 5. Somewhere around here, you will have a more solid understanding or realization that price is very likely is going to hold over here. Again, no certainties, only probabilities. Ask yourself, what is the probability of price being held over here and push higher to this high or to this high? I would say if I see this consolidation happening on this daily fair value gap, I would say it's 65 to 70%. It will hold. And then what happened after that? The 7th day, push up, breaks new high, sweep all the liquidity on the buy side, and one more time to create another fair value gap. Interesting, isn't it? Fair value gap, decline. This was a massive decline to sweep the lows over here, and then the next day it got held over here in this fair value gap and continue to push higher, and another fair value gap formed. 3 down days, down, down, down candles, down close, touch the bottom of the fair value gap, which is almost equal to this. I would say it's equal to this candle's high, and continue to rally. Now here, this very simple depiction over here shows that the fair value gap is part of the institutional order flow, holding the price, pushing up higher, and those areas where the fair value gap is formed, very likely institutions are reaccumulating over there. That is why the price cannot break a specific low, which is this low and this low, and of course definitely that low. That low is not broken. So you know it's consistently creating higher highs and higher lows with the reference and guidance of the daily, the higher time frame fair value gap. So determining bias is also one of the usages of fair value gap. Next, bias can be number one, correct to your judgment, or number two, what if you're bullish for the week, however, price action does not show that it's very bullish? Should you switch gear on the spot? Should you counter trend and then follow the trend later on? Right? So much guessing games, right? So sometimes the fair value gap can tell you that the bias is changing, probably short term, not for the entire length of its move, but maybe in the next 1 or 2 weeks, there's a deeper retracement incoming, and you can capitalize on that and not get caught offside. Here is a very good example. The daily chart, if you look at the weekly chart for this US 500, it's actually trending bullish. This chart is this year's 2023 chart, and you know S&P 500 has been bullish all the way. So if the price retraces into a specific optimal trade entry or Fibonacci retracement here, you may think, oh, I should buy, but you will get trapped and you will get stopped out. Why? Because there's a further one more impulse leg down. So this impulse leg down, this displacement down, aggressive move down, left a fair value gap. Fine. There's also another one on top. I'm not going to touch on that. I'm going to talk about the bottom one. Price retrace into it. Many may see this as a continuation run on the bullish narrative or the bullish momentum. However, one impulse down, another one, and another fair value gap has been created. So we have one fair value gap respected because price moved away from it, and another one being created and potentially could be respected again. So over here is a flaring warning sign that A, do not try to long over here. It's dangerous. Potentially, if price goes up, look to the lower time frame, H1 or 30 minute, 15 minute, there could be a rejection on a specific time of the day, likely London or New York session, that could push price further down and take out this area of liquidity and probably visiting this old fair value gap again and this little consolidation over here, which happens, and then the trend continues to go higher. So over here you could have potentially utilized a change of bias, a change of context short term, because the bearish fair value gap has been respected. So you can take a sell over here before you buy to ride the continuation up, which is ultimately that is the higher time frame, long term, mid term narrative. But the short term, you trade the retracement simply because the fair value gap on the higher time frame daily has been respected, and we need to give that fair value gap the right amount of respect, and do not just jump in and stick to one bias too tightly. So again, this is another way fair value gap can help us to form or help us to confirm there's a narrative change short term, direction change short term. Next one is the fair value gap as an invalidation. Invalidation usually comes in at lower time frame. Why? Because again, I'm using the 15-minute chart, so I assume those who are able to resonate with this are scalpers, intraday traders. If you're a position or swing trader, just switch this to H1 or H4. Same concept, same idea. Now, having said that, invalidation, when we enter a trade, we place a stop loss. How much does the price need to run against us for us to go, okay, my bias is wrong? Should we wait until our stop loss get hit? Or is there a way to tell that a certain price level, if the price crosses that specific level or the specific zone or area, whatever you call it, we should remove 50% of our position, or we should just entirely just exit because price is not doing what we want it to do to justify our so-called initial bias or hypothesis? Fair value gap can help you to do that. So from this example here, when the price rally, we see a liquidity rate on the buy side and then it decline. This itself is going to attract a lot of sellers, definitely, because displacement lower, left a fair value gap, a retracement into here above 50% into 62 or 70% of the Fibonacci retracement, that would entice all kinds of sellers to jump in, SMC or not SMC. Again, a break of structure further confirms the bearishness. However, yes, it did decline. That one, yes, correct, it did decline after it visited the fair value gap. The first test that closed red was this candle. Second time it went up there again and closed at the bottom like a doji. So we have two dojis. Third one closed lower than the previous two and closed red as well. Down close again and down close again. If you do not take profit here, this candle will scare you. Why? Because it rallied back so strongly and the candle closed above 50% of the fair value gap, high and low, the midpoint. It closed above. That is a classic sign that this fair value gap very, very soon will be broken. It cannot hold anymore. Price keep returning back to the fair value gap number one, and there's a candle that closed above its 50% point. You do not need to wait for your full stop loss to get taken up. You can just exit with a small loss or break even, or 50%, you exit half of your total stop loss amount. If you are risking 1R at 1% of your capital, you should get out 50% of 1% and see if it really wants to deliver higher. If it does, then you just lose way lesser than what you're supposed to lose, your full stop loss amount. So this fair value gap also serves as an invalidation, as a warning sign, red flag, so that you do not continue to hold on to a specific bias too tightly. Why? Because it's showing you in the charts. Put it simply, it's like that. So fair value gap is multi-dimensional, multifunctional across time frames. Whether you are a swing or a scalper, you can still use the same concept in a different time frame. You can use fair value gap as one of your tools to add confidence, additional confirmation, or as an entry technique to your pre-existing trading model or plan, right? Because fair value gap is not the holy grail. It's not the Hail Mary or end all be all. No, you shouldn't take fair value gap as the one and only indicator or one and only tool you use to determine everything in your trading. No, I think that's very dangerous. You should be incorporating other technical analysis or fundamental analysis into the picture to give you a more well-rounded analysis to help you in your trading. So that is all for today about fair value gap application. This is Seafood Steve signing out. Thank you so much for your time. I'll see you again, right? Take care. Bye bye.